All right, y'all, we are live. Welcome to another episode of Speak On It. I'm your host, Dom, with my co host, Tim. It is Awareness Monday. We want to bring awareness to y'all in every fashion and every area of life. Um, we got a special guest on here, my man, Kevin. He is going to kick knowledge to us from the real estate game, from the mortgage lending side of it. But before we do that, make sure that y'all definitely go and share this. Make sure that y'all are liking it, tuning in. Make sure you get your pen and your paper ready because he's about to drop some gems and a lot of knowledge for you guys. But without further ado, I'm gonna let my man Tim say something to the people.
Hey, what's going on, good people? Appreciate you guys tuning in. Like you said, we're gonna have Kevin Jefferson, aka the People's Lender, give us some tips and some knowledge on mortgage lending. Um, so, without further ado, we'll have Kevin introduce himself.
Hey everybody, I'm Kevin Jefferson, mortgage lender with American Eagle Mortgage. I'm down in the Metro Atlanta area, and I'm originally from Delaware. Been in the business between being a realtor and a loan officer 17 years.
So you got a lot of knowledge. Gonna drop a lot of gems on us.
God.
So go ahead, Tim. I'm gonna let you kick it off with your first question. Well, actually, we'll go ahead. Yeah, go ahead.
So, what got you into real estate?
I've always had an interest in it, and actually, man, the story is crazy. So I graduated from Dell State in 2002, and I was having a rough time finding a job, either overqualified or didn't have enough experience. So, like everybody else, I was like, well, let me go back and see about getting my master's degree. So I went over to Wilmington College and I had a session with an advisor on getting my master's. So I walked out of the meeting with the pamphlet, with the folder, and I happened to be looking. It was over at Dell Tech, so I picked up the book, the community college book, and I flipped through it. And like on page 2, they were offering a real estate class. So I stopped right then and there, and I called, and they told me that the class was full, but they had a waiting list, and it was like 496. So I, literally standing in the hallway looking at my paper, and I was like, $10,000 for a degree or a real estate license, and I paid less than $500. So needless to say, I ended up getting into class and been loving it ever since. I've been through the, great time. I've been through the Great Recession in 2008, 2009, and then I'm back in the heyday right now. So it's just something I liked. I've always followed it, and I grew up in a house and talked to people about land. Just something that I've always had interest in.
You got a question?
Yeah. So you said so you got your real estate license in Delaware. Am I correct?
Yeah, I got my license in actually I got my license in Maryland
Okay.
first, and then I got Delaware license.
Gotcha. So, um, what are the different markets like? I mean, so you started in Delaware, or you got started in Maryland, went to Delaware, and now you in Atlanta. So tell us about that journey. Like, what are some of the lessons or the different markets that you've been through? Tell us some of the different um things you learned in each market.
So in Delaware, it's a little bit more rural. So we did a lot more, and I was an agent then. Now I'm a lender. So when I was an agent, we did a lot more of USDA loans, 100% financing loans. At the time, for me, just where we were, it was smaller amounts. But I saw, it was a need. Delaware is smaller, but it's still a lot of people that want to buy houses, and there's a supply shortage. So when there's a supply shortage, prices increase, and there's bidding wars and demands. Fast forward to now, being in Atlanta, It's crazy, man. I see people who, put in offers on houses and they're one of 29. So you bidding against 28 other people. Cash, not cash offers, but they're offering over asking price. Like I've never, in the heyday, 2005, 2006, I thought that market was untouchable, but this one, I hadn't seen anything like it. And even though I'm here, I still keep my pulse on back home. And, it's hard to keep things on the market in Delaware as well, Maryland. If it's a desirable area, it's even harder. Great school district, it's even more competitive. So, and that's where I'm at. Like we're in the largest county in Georgia, and it's one of the top school districts in the state. So, houses don't stay on the market long. And I say long, I know an agent, she put the sign in the yard in the morning, by the evening it was gone. So it's real competitive. Interest rates at an all-time low, and people have, they're positioning themselves to become homeowners. Because the one thing I've learned, man, is that no matter what the market is, rents don't decrease.
Right.
So now you're at a point where if you're paying $1,200 for rent, you could potentially buy a house for less and pay less than a monthly mortgage, or just a little bit more and be the owner. So it's just amazing, man. This market is amazing. It's a great time to buy for everybody who can.
One of the things you said is it's definitely a great time to buy, especially with the interest rates being low. Now, can you tell me how is it that the interest rates affect the mortgage payments? Why is it that now is the best time because the interest rates?
So you just kind of like anything else. In some senses, the interest rate inside of a mortgage payment, you got 5 components. You got principal interest, you got homeowners insurance, you have taxes, and you have mortgage insurance. So nothing you can do about taxes, right? In terms of how much you pay. Homeowners insurance, you can shop around, but at some point, it's nothing you can do about it. You can go to State Farm, Allstate, Geico, Progressive, mom and pop insurance. At some point, it's only going to be so low. The interest rate is what you pay interest on to borrow that money over time. So a lot of times, most people want a 30-year fixed rate, and it's fixed for the life of the loan. So the interest rate does play a huge part in some cases to where it keeps your payment lower. In some cases, some people think it weighs more than a larger down payment. I've had clients who want to put down more money. However, to me, I said, hey, why don't you take $5,000, buy down the interest rate? This is what your payment is, and then you have more money in your pocket. Because if you put it all towards down payment, that payment is spread out over 360 months, as opposed to making an immediate impact.
That was a gem right there.
I was going to say that's a gem alert. That's definitely a gem alert
right there.
Buy down the interest rate, and not the boy. Okay, I got to rewatch that. But now you said that if you with a 30-year mortgage, you're stuck with that interest rate. Now, would it be the same cases versus a 15-year fixed, and what would be the difference in that?
The 15-year fix, so contrary to what people believe, knocking down the term of the loan doesn't double your payment. It's slightly higher. You got to have pretty good credit to qualify for it. However, it does allow for you to pay the house off quicker or faster, and it also allows you to pay less in interest over the time. But I've only ever done, since I've been a lender, I've only ever done fixed rates. I don't do adjustable rates or anything like that.
No, you got a question?
So I think so one of the things he was talking about is paying off or putting that $5,000 down and paying it towards the interest. How can you do that during the course of your whole loan? Because I know a lot of people are just actually just paying and not knowing that a portion of that is going towards the interest and a portion of it is going to the actual mortgage loan. So how can we just start paying faster on the interest rate as opposed to a portion going to the loan and a portion going to the interest?
Gotcha. So when you purchase a home and you get a mortgage, the first 10 years, majority of your payment goes towards the interest. After that 10 years, more of it begins to go towards the principal. So with that being said, on that same 30-year fixed mortgage, if a person pays one additional payment a year, not a month, not every other week, one additional payment a year, that takes the term from 30 years to 22.6 years. And the reason why that is, when you make that additional payment, it's knocking down the principal. And as you knock down the principal, you're paying less interest. So over time, you accelerate the amount of time that you have to pay off on the house.
That's another gem right there. That's another gem right there, because like you said, just one extra payment, one in a year, cut 8 years off of a loan.
Pretty much, man. And just think about it. And you do it once a year. So you get your tax return, instead of balling out getting new furniture, just pay one additional payment and you're helping yourself over time. And not only that, you're building equity because you're paying down more of the principal as opposed to the interest at that time. So you're building equity in it as well, along with the market building equity.
We 50 minutes in the show. He done dropped 2 gems already.
Man, y'all need to bomb like Clue. Boom.
Yeah, we ain't got the sound effects yet.
The sound effects, man.
But even going back to I want to kind of go back because I know we're delving into mortgage and we're speaking more so to homeowners, but let's speak to the ones that are trying to obtain home ownership. What would you say would be the stumbling blocks, I would say, as far as a first-time home buyer is concerned? What are the main things that you've seen as far as the biggest stumbling blocks that can hold people back?
Credit, number one. Car payments, number two. And 2A is student loans. Last episode, you guys had my go-to, Shannon Payton from Payton Credit Services. She's been my go-to for credit clients for the last 8 or 9 years. So, somebody comes to me, if it's not something basic that you can do with credit, I just send them to Shannon because she gets them in position to purchase. So the one thing is, we're not taught about credit. Even though my mother owned a home, now they purchased cars, they never really talked about credit because they didn't know. They just knew to pay their bills on time. And, my mom didn't have any credit cards. Grandma didn't have any credit cards. So, we don't really know the formula to credit. We just pay on time, or we pay in cash, or, most of us, pay money orders and keep the receipt. So just establishing credit, man. Because the thing of it is, the stigma with credit is, people are afraid to get credit sometimes. And then if somebody tells them to get credit, the first thing they want to do is run and go get a car. So, there's other ways to establish credit. So that's number one, the credit challenges. Not paying attention to your credit, not monitoring it. I mean, it's the reason why they allow for you to get your credit report for free once a year, so you can at least take a look at it and see what's on there, because some of the stuff is not accurate, should have been gone, and may not even been yours. So you just definitely got to pay attention to your credit. And sometimes I run across people who are scared to look at their credit to find out that they got a 650 and can buy, So you just got to be, the fear of the unknown, I guess.
Mm-hmm.
The next thing is student loans. A lot of times people's credit, they pay their credit cards on time, card payments on time. But when Department of Education reach out to them, instead of setting up a deferment or forbearance or income-based repayment plan, they ignore it and it gets put into collections. It comes out of deferment. They don't pay attention. And if they got 10 student loans reporting on their credit and it's late one time, that's 10 lates as opposed to one if you consolidate your loans. So, that's the biggest thing. And then just car payments. If your credit's not right and you got a Kia, sometimes I've seen Kia payments look like Benz payments because the interest rate's so high. So then that kind of knocks you out of ranking, so you have to position yourself with the score. If you want to buy a house and you don't make a lot of money and you have other bills that report on your credit report, try to hold off on a car, take that tax return and buy one cash until you can get the house. I always tell people you can always get the car after you have the house, but vice versa is tough.
Can you elaborate a little bit more on, you said car. So are we talking about debt to income ratio or debt to income ratio?
Yep. So let's use all three of those components, right? You've got the credit score that's, let's say, 650. And you have a car payment, let's say $600. And you have student loan debt. And if, your student loan debt, let's say student loan debt's 50 grand. Well, if you're using FHA financing, even though you aren't paying any payment on your student loans, we have to count some sort of percentage into the debt to income ratio. So that's 1%. So if you take that $50,000 student loan debt balance, we have to add $500 payment, even though you're not paying it. You don't have to pay it. We just have to add it into the formula for your debt to income ratio. You take that, that's $1,000. And let's say a person's making $2,500 a month, or let's say they're making $3,000 a month. That's a third of their income right there. And we haven't even looked at credit cards or any other type of installment loans that they may have.
That's another, like, I think that's super important, especially in our community, because like you said, one of the things that we want to do is we want to go out and get the car. We want to go out and get the phone. We want to go out and get all these things, not knowing, because we aren't taught about credit. We aren't taught about how to do these things, not knowing that there's this thing called debt to income ratio. When you go look at a house, to buy a house, those are the things that's going to be looked at. And we are told to go get a car because that's one stream of income to help us get our credit right, get our credit right. And we're told to go get the credit cards because that's another way to help us build our credit and get our credit right. So how do we get around that, right? Because if we need a car, we need a phone, and we need these credit cards to help build our credit, what's one of the ways we can actually get around that to help build our credit, because we need a car to help build that.
Right. So it kind of goes back to knowing your credit. So example, you go to the car dealership and you say, hey, I'd like to get this, 2020 Lexus, right? Well, if you go there and allow for them to have somebody pull your credit and you don't know what your credit is, they're going to have to shop you around. Let's say you go to Dover Credit Union or one of the credit unions in Delaware, Trademark, and you apply and you go to the dealership already approved, you already know your budget, you know what your interest rate is, and they don't have to shop you around. So that helps you be in position. But you want to make sure that it just goes back to living within your means. I run into people who use their credit card and they have enough disposable income. They use it because it's the first thing they grab. They rather keep the money in their pocket when in the long run, they're paying a little bit more. And credit cards have their purpose in helping build your score, But if your credit card, if your credit card utilization is over 30%, then you're not getting the amount of points that you could get with paying your payment on time, even if you've never been late. So I always explain to clients, credit is a snapshot of where you are at the moment. Doesn't mean you're a bad pay person, your DTI. Like right now, a lot of people probably charged up credit cards when they were laid off or furloughed because they didn't have any other choice. As you pay down those credit cards, it's a scoring algorithm, and your score should continue to increase again, as opposed to when you charge up your cards on everything. Knowing your student loans, what they are, how much your payment is, what type of payment plan you're in. It's just knowing your numbers. Let's equate it to sports, right? If you're an athlete, you know how many minutes you playing, you know the plays, you know how many points you need to score to get to the next goal. You know how many points you average in a game. You know your rebounds. You know your assists. You know all your numbers. And that's the same thing with your credit score. You need to know all of your numbers, what your debt to income ratio is, what your what your scores are in the 3 credit agencies. And you just need to keep up with it. It's got to be a part of your everyday life. I look at my credit score like once a week because I want to make sure that nothing's not popping up on my credit that shouldn't.
It's one of those things, those times where ignorance is not good. Well, I never think ignorance is good, but a lot of people will say, man, it's better not know than, but that's ignorance.
Right.
But like you said, if you don't know where you are, there's no room for improvement. There's no way that you can get better.
Yeah. Like and I tell clients, I run into it all the time, man. YouTube and Google University are not always accurate. They're only good as the information that somebody puts on there. And if the wrong person without the right information puts it online, then you're getting the wrong information as well. So it's just, you have to start somewhere. People have hiccups, it's a lot that you can do, but in terms of home ownership, I think it's for everybody who needs somewhere to live. I know that's in a perfect world that would mess up landlords and investors like ourselves, but at the end of the day, we have to educate ourselves on the process and just get started. Reach out to a lender, tell them you'd like to purchase a home, and have them run your credit. And then some of them will give you a game plan, or they'll tell you what you need to do to be in position. And sometimes you're in a better position than you think you are, but you have to start somewhere.
Now, one thing I want to say to Dom, I didn't ask for student loan debt. I didn't ask for it. You know what I mean? And I had to.
Right.
So I definitely commend you on making that decision. I wish I made that decision, but as far as choosing the 495 versus getting that degree, because listen,
so I got true story.
It's a lot of us that has a degree that didn't ask for the debt, huh?
Yeah, I went back and got the master's though.
That's all it is.
Hey, that's what's up. Listen, yeah. True story, just like Tamon said, right? So you say didn't ask for it. I looked at it, just like what Kevin said. I went to school for psychology. I looked at it. Bachelor's degree was $56,000 for in psychology. Coming out was $29,000. That's what they was gonna pay me a year, $29,000, and on a loan of $56,000. And they said if you wanted to make some real money, like get into like the $60,000, you gotta go back and get your master's and doctor's degree. And they was gonna add another $80,000 on top of that. So I was like, I'm $140,000 in the hole, and I'm only making $60,000 a year. Right. So I had to make a choice. I said, man, listen, I take the knowledge, I take the books. Other than that, I just feel as though that it wasn't beneficial for me to pursue that degree because the numbers didn't make sense to me. So it's not for everybody. You know what I mean? But
yeah, we are not promoting not going to college.
Not promoting going to college. I
Go
promote
to school,
education. I promote school. It's not for
preferably
everybody.
at HBCU. That's my plug. But we're not saying to not go to college.
It's not. Yeah, it's not. It's not saying that don't go to college, but it's saying educate yourself before you do something, before you make a big step or a big decision. Because we all just want to get knowledge or just do something. We jump into things not knowing what we're getting into, and once you I mean have a game plan, you know what you're getting into. 140,000 to somebody is not a big thing, right? Because they're gonna come out and they're gonna make that, and they're gonna be able to pay that off quickly. If I mean they have a game plan. I mean, so that's what we're saying is just educate yourself before you do anything.
Right.
Another stumbling block, a couple more, bankruptcy and tax liens or judgments. How do those affect purchasing a home?
So if you had a bankruptcy, you can purchase a home through FHA after 2 years if there was no home involved. If there was a home involved, you're looking at 3 years. With conventional, with bankruptcy, you're looking at 4 years. And if there's a house that was involved, you're looking at 7 years from the foreclosure. The other thing is there are some cases where we can finance you while you're in the bankruptcy. That's Chapter 13. You may not maximize your be able to use all of your debt to income ratio, but typically at that point, the only thing you have is your bankruptcy payment. So, I would definitely check in. So people can make mistakes and still purchase a home. There's a time limit, a time frame that you can do it, but 2 or 3 years goes by pretty quickly. Tax lien, as long as it's some sort of payment arrangement made on it, you can still purchase. And what was the other one?
No, it was tax lien, judgments, bankruptcy.
Yeah, tax liens and judgments, same thing. As long as you got a payment arrangement set up, and you have proof of the payment arrangement and you've been paying on time, we'll just add that payment into your debt to income ratio, and we can move forward with it. So none of those things stop you from purchasing.
So to the audience, there's nothing that's stopping you as far as purchasing a home. You just gotta get yourself together as far as your credit, debt to income ratio. Even if you have stumbling blocks like student loans, bankruptcies, tax liens, and judgments, still can get it going. So that is definitely a positive for us, especially looking at the statistics and as far as us as a people. When I say us as a people, meaning Black people, as far as home ownership is concerned, we are lagging in the race if there was a race. And I know that a lot of these things, mainly in my perspective or my generation, will be mainly student loans, is something that will be a deterrent as far as purchasing a home. But what are the different type of loans? I know you were touching on FHA and also conventional as well. What are the different loan products that are available to one that are purchasing a home?
So you've got FHA, which is the Federal Housing Administration. They have a down payment requirement of 3.5% of the sales price. You've got conventional, which has a 3% down payment requirement in some cases of the sales price. For our veterans who are active, retired, separated from the service, you have the VA loan, which has a 0% down payment. You still have to pay closing costs, which people get tripped up on, but you still, it's a zero down payment, as well as USDA, which is a zero down payment program. When I lived in Sussex County, we did a lot of USDA because at that point, the whole county was USDA because, just the way it sits on the census tract. We also have, my fault, we also got a few renovation loans, new construction, one-time close loans. But the big four is FHA, VA, USDA, and convention.
And what would you say as far as I know you were talking about a down payment, and that would be as far as getting yourself together, your credit score, down payment. What would you say would be a good range for, let's just say a family of three would need in order to purchase a home, idealistic?
So it just kind of depends on, what you're looking for. So let's take example, a $200,000 house. If you take a $200,000 house and you're doing FHA, the down payment's 3.5%. So that's $7,000. You take closing costs for that, on that property, and let's say it's another $7,000. So you're looking at about $14,000 needed to close. That includes your earnest money deposit. That's typically around $1,000 to 1% of the sales price. And then you've got your appraisal, which runs from I think maybe $400 to $500, and then you got your home inspection. So total all in, you're probably looking at about $15,000, give or take, on a $200,000 house. There are programs that can help you with the down payment, but you want to try to have as much of your own money as well for closing costs.
So in other words, we need to stack our bread. If you trying to purchase any home, you need to stack your bread up, get your credit right. One of the things what you were saying as far as the cars, and it was a thought that came to me. What would you say as far as refinancing your car payment to get it down, as far as your payment down, to help with your debt to income ratio? Oh no, did we? Hello? I said hello.
I think
You
that's a
there,
good
Kev?
question. I definitely think that's a good question.
You there, Kev? I see him.
So what he's saying right
Yeah,
now
I'm here.
is,
He can hear you now.
what he's saying right now is that to refinance your car. That's a good question that someone asks. For me, and I ain't no expert. Kev's the expert. But I think it's a good idea just looking at it as far as the income ratio, because it lowers the monthly payment. I think Kev back. Is Kev back? Oh, he coming back.
Can you hear me?
Yes, sir.
All right, yep.
I can hear you.
All right, cool. So what I was saying was, you don't necessarily have to have the $15,000 saved up. but you do want to have access to some funds. There's products out there for first-time home buyers that will allow for you to get assistance with the down payment. You could potentially get some help from the seller on the closing costs, but you do want to have some of your own money available. There's other options. You have the option of getting, help from a family member. It's called a gift. And then if you have a 401k, you can also tap into that and get your down payment without being penalized.
Okay, so maybe you had missed the question. What I said is what I was thinking about when you were saying about the car payments. Refinancing a car payment, would that be something that you would advise? Because that was the first thing that I thought of as far as helping your debt to income ratio.
Yeah. So if you're refinancing a car and your payments, and you refinance it, let's say you save $100 that you go to the house. We look at how much monthly and how much does he have going out monthly. It's not necessarily that he has $300,000 in total debt, because some of those payments are going to be different. But we look at what goes in monthly and what comes out monthly.
There's another gem.
Yeah, definitely. Like I said before Kev was getting back on there, is what he said is that's what we look at. They just look directly at what you got coming in and what you got going out. And that's how they're going to determine your debt to income ratio. It's not, the total amount that you owe on a car payment or the total amount that you owe on something else, but or on a student loan, but how much of that is coming out each month. And they want to know if that you can actually pay on this mortgage. So like Taman said, that's a gem right there, because to refinance it, to me, it's just something that's just to think out of the box, where you get those lower monthly payments from the car, and that the money that you save can actually go towards the house as well.
Yep.
Now,
Sometimes it's just.
I'm sorry. Go ahead.
Sometimes it's just. Yeah, I was saying. Sometimes it's just the difference. We look at it. Well, $100 a month is not a lot of money, but it could be the difference between getting the house you want and not getting the house you want.
Mm-hmm.
Now, can you get a mortgage without having a credit score?
You can. What we do is add non-traditional trade lines, which would be one has to be your rental history. So if you plan on doing it, you need to make sure that you have a good rent history with your landlord. And please, if you're looking to purchase a home and you don't have a score, or you may need a manual underwrite, please start paying your landlord with checks that you can trace. We can't cash app, and we can't send, we can do the money orders and cash app, but it's a lot more paperwork you have to get. And don't pay in cash, because not, anybody can make up a receipt saying that Bob Smith paid me X amount of dollars. We want it to be traceable. Then there's, besides the rent, we look at two other trade lines that we can add, that you have 12 on-time payments in the last 12 months, meaning not late in the last 30 days. Car insurance, daycare bill, childcare, just something that we can verify, showing that, okay, he or she may not have established credit. However, these items here show that they do pay on time.
So to piggyback off that, what does that look like? So when determining interest rate, so say I have all those things, but I don't have a credit, because credit determines how good I pay, right? Or what you guys would look at as far as a loan. If I have those things and I don't have credit, how does that affect the interest rate that I get on the loan?
So your rate's going to be slightly higher
Okay.
because there's a level of risk. Before I put anybody or do that situation, I'm going to see how long it may take for us to get them a credit score. If we don't have the time to get a credit score, then I'm going to add, we're going to add the trade lines and get them into a house. Now, yes, the interest rate is slightly higher. And when I say slightly higher, I'm not talking about 6, 7, 8%. I'm talking about if rates are 3.25, we might be looking at a 4, 4.25. Still not a bad rate, still cheaper than what you pay on your credit card. Once you've established your credit score, maybe 6 months to a year, then you refinance out, do a rate and turn refinance to get the lower interest rate. But that is just a temporary way of getting into. It's a way of getting into a house without having to wait 6 months to a year.
No, good to know. Now, once you're in the house, what would you say would be a good time for you to refinance if that's in your plans or your thoughts?
So you typically have to wait 6 months to a year to refinance. But the biggest thing about refinancing is you're refinancing over, meaning you can't have taken if your income has an increase, you can't take on a bunch of additional debt after you buy the house, and then you have to have equity in the house if you're not doing the FHA streamline. Equity means I brought a $100,000 house, $80,000 house. Now it's worth $100,000, so I've got 20% equity in my house, and I want to refinance out, get a lower interest rate, and get rid of maybe mortgage insurance. So the house has to be worth at least what you're trying to refinance. If you don't want to bring any funds out of pocket, then it has to be worth what you owe plus the additional charges, so you don't have to come with additional funds.
Any questions, Dom? Before
No, I ain't got nothing right now.
I'm about to dive into this investor lending.
Yeah, that's what I wanted to get into.
So, as far as real estate investors are thinking, as far as mortgage lending is concerned, or lending, what would you say would be some of the investor loan programs that will be available for an investor?
So you've got conventional financing. We can go as low as 15% down payment, and as long as you have 15% down, and you need to have at least 6 months reserves for that property, whether it's occupied or not. So if the mortgage on a property is $500 a month, after you've paid down payment and closing costs, you need to have an additional $3,000 that you can access just in case the property stays vacant for over 6 months. For 6 months. You also have, there's some conventional renovation loans called home style. The only thing is, since COVID-19 hit, a lot of those products were suspended because it's an additional level of risk. You can buy multifamily with the conventional route as well, but instead of it being 15%, you're looking at 25%. And then you need to have reserves for each one of the units as
well. Ooh, that multifamily, you might have to get some partners in on that one.
Yeah.
Now,
so let me drop something on you, man.
Please
I'm gonna drop something on you. So if you're a home buyer, and let's say you go with FHA financing, you can finance a 1 to 4 unit property as long as you're going to live in one of the units, and that's with just 3.5% down. So that a lot of times people buy and they want to buy a house. If I knew then, I would have did that. That would have been the easiest way to get into investing, because you'll be living in a unit, and then the tenants will be paying your mortgage.
And you only gotta, if I'm correct, you only gotta stay there for 6 months to a year, correct, before you can move out and do it again, right?
Kev.
Yep, you can do it.
Oh, okay.
Can you hear us?
What are you saying, Dom?
So what he's saying right now, he's saying, I'm not no expert,
Okay, no,
but
no, he's
Kevin.
back. He's back. He's back. I heard him
I'm
laugh.
back, man.
Oh, all right.
Yeah. So I was saying
I
you
almost
can
heard the
just
question.
rinse and
Okay.
repeat. Yep, just rinse and repeat, man. You stay in there a year, and then you find another property.
You muted them?
No, I didn't touch anything.
Well, I think that's is important, and just to get in the mindset is, especially when you're coming out of renting, right? So if you're coming out of renting and you want to own your own home or you want to get into investments, to me, it's really when you're living in one of the units, it's really like renting again. I mean, just getting that mindset that I'm only going to be here for a year, and then I'm going to put a tenant in that place with 3 other tenants or 2 other tenants, I mean, or one other tenant, I mean, depending on what unit you have, and then you can get out and then purchase the home that you actually want, and then have that residual income coming in off of a unit that you purchased as a rental property.
Hey, listen, man. I told that. What's funny is that I was having a conversation with this young guy in my neighborhood. I think I mentioned him before, truck driver. He's probably like 23. And I told him that. I said, listen, bro, your age and the money that you're making right now, he's trying to look for a house. I said, bro, if you can find a duplex or a triplex, get that and stay there for like a year and find 2 tenants. And then once you leave, you find another tenant. Bro, your house is gonna be, your mortgage payment is already paid for by the tenant plus the extra money. He was like, yo, you right, man. He was searching, but it's hard to find a duplex in the state of Delaware, nonetheless. But just understanding that mindset of like Kev was saying, if he knew that then, if I knew that pre-kids, you know what I mean? I would definitely take an advantage of that. But now I'm not gonna say that I wouldn't put my family in that position, but I don't think that would be conducive because then I would be property manager on the block, and I'd rather be Al Heyman behind the scenes as far as property management than.
Yeah. So if I'm not mistaken, property manager, right? If you hire a property manager, they can only make. I mean, you can pay them 10% of what the total cost is. So even if you hire a property manager, 10% on like a unit 300,000 or a rent that's let's say a rent is $1,000, you only pay them 10%. That's $100.
Yeah, that's why I would go that route. That's what I'm saying. I would rather go that route. So that's why, as far as that strategy, me, 35, 36, 3 kids, wife, nah, that's not gonna work. But you with no kids, that would have worked.
Yeah, I think that's the biggest.
Wifey,
Yeah, I think that's the biggest.
wifey
biggest
definitely ain't
obstacle.
going for it.
Nah,
That's the biggest obstacle right there, man. Is just what you having when you have kids and the family, and then you're like, man, I want to do this. I want to buy a duplex or a triplex, and we're gonna stay in one of the houses, one of the units for a year. Yeah, I mean, convincing the boss that it's a great investment property or investment strategy. Um, that's tough.
Now, as far as oh man, you were talking fix and flip loans. Are you? I'm assuming that you're familiar with them.
Nah, I don't
Okay.
really do them. I usually refer them out to a hard money lender who's
Okay.
more equipped for that. Our stuff is probably more buy and hold, um, especially with the home style renovation loan being on hold. So yeah, fix and flip typically goes with a hard money lender.
So as far as the buy and hold strategy, right? One of the things that intrigues me is the They term it a BRRRR strategy. So you buy, you rehab, you rent it out, and refinance. Now, as far as the refinancing part, that would be to where I would come to you. Now, if
Right.
someone is in a position to where they have a fix and flip loan to renovate the property, or a hard money loan. Let's not label it as a fix and flip, but a hard money loan or not a conventional loan, something short term, and they would like to refinance it to rent it out. I know you said that there was a 6 month period. Is there there's any gems around that? Or
Well, yeah, in that case, you don't have to wait 6 months. You can do it as soon as possible because that hard money loans or private money is non-traditional, so it's governed a different way. So if you're in a situation where you're doing a fix and flip, the numbers don't work anymore, but it works as a buy and hold. You can refinance immediately because at the end of the day, you want to get that money back to the lender as fast as possible because it costs you less and it helps you build that relationship. Saying, okay, Dom and Tim, we're going to give me my money back as soon as possible.
so in a scenario where I'm putting math together, if I buy a house for 50,000 and it needs 50,000 worth of work, and the property is worth 100, no, yeah, 150, right? And how much would I be able to refinance up to for that 150?
So it'll probably give you 80% of loan to value.
So that would be what, 130, 135?
Yeah, somewhere around there, 130, 135. Um, that allows for you to get into a conventional loan and not have to pay any mortgage insurance.
So in turn, I could actually put that money in, refinance it, take that money out, and then do it all over again.
Yep, that's the BRRRR strategy.
That sounds so lovely.
Yeah.
Was it a gym alert?
That's another gym alert. So this burr. Um, does that 6 month period affect that as far as doing that over again? Because I mean, as far as the mortgages, when we're talking about debt to income ratio, you're talking about getting multiple mortgages. How would that, or how could you see that work if
So
it can?
it can work, but it has to be um, it has to be spread out over a certain period of time. Now, guidelines have changed, so you have to have some sort of experience with renting properties in order to count the lease uh, towards helping you qualify. So, example, if you're renting a property for $1,000, and what we'll give you 75% of that is income, because whether there's issues or not, over some point in time, you're going to have to replace the roof, replace windows, carpet, paint, or something to the house. So we give you a flat 75% of that. So that's $750 a month. If your mortgage is 650, then once we do that calculation, it shows you have a income of an additional $100 that can be counted towards your income. However, if that same mortgage is $800, then you're losing $50 a month. So that $50 a month counts against you. So at some point, you're going to have to make sure you are cash flowing properly so that you can use those rents to help you qualify. Because it's not likely that your income from your job is going to increase at that same pace. So at some point, you have to be strategic and make sure that you're charging enough for rent. I've seen people mortgage be 750 and they think they're okay because they're charging $900, but when we do the formula, they're short. So you have, all of those things help with helping you qualify for more. Because like I said, your income isn't going to increase at the same rate as, the rentals.
Okay, so Dom, you picking? I'm trying to pick his brain.
Yeah, well,
Because listen, I don't want this for personal use. This is
I'm with you. You know, this is business. This is business. But I want him to break down what he just said because that math don't compute with me when he said a loan. My rent is $750. I charge them 900, and then I'm still losing money.
Right. So let's take that $1,000. Rule is you can get 75% of the income. So if you're charging $1,000 for rent, when we look at it and you're trying to finance the house, okay, we can give him credit for $750, right?
Mm-hmm.
If your mortgage is $650, you have a positive income of what we can use for calculation in is $100, right?
Mm-hmm.
However, if we give you 75%, if we do 75% of 900, I'm gonna do the math right quick. If we do 75% of $900, that's $675. If your mortgage is $750,
Yeah.
then you're losing $75.
Yeah.
Yep. Even though you're really charging 900, the calculations that we have to use, you're losing $75. So then that negative $75 counts against you and what you can qualify
Listen, that's another gem right there because, like you said, when people going into it and just want to be investors, just doing that math, just basic math off the top of my head, I say, I'm only paying 700. I'm gonna charge you 1,000. You know what I mean? Not knowing that in the long run, behind closed doors, behind the scenes, I'm losing $100. You know what I mean? So I think that was you know what I mean, good. That was informative to me.
Gotcha.
So as far as someone who is they just purchased their home and they went through a government program. And when I say government program, Fannie Mae, Freddie Mac, um, and they're in it for the year and then they want to move out, they want to rent out this house. Are they able to do another government?
So with FHA, and I think the same thing with USDA, that's the thing. Your houses have to be at least 100 miles apart if you're going to have two FHA loans. So at that point, if you're looking to move into a different home, you're probably going to want to try to get a conventional loan. So at that point, you need to make sure your credit score is higher and that you have no blemishes in the last 12 months because when conventional financing is conservative. The same thing with USDA, the same thing with VA is a little bit more flexible. So at that point, when you're in the FHA, you want to be able to go to a conventional loan to keep your FHA house. And then, you can have as many conventionals. You can have up to Fannie and Freddie. I think it's like 8 loans. It could have changed during COVID. I have to check. But, you can't have an FHA loan in Bear and then go to Middletown and have FHA loan also.
Gotta be in Lewis.
No, that ain't 100 miles apart. You got to be.
You got to be in Claymont and buying Dalmar. That's about 100 miles, man.
So as far as making that work, you can't mess with the government's money.
I think, man, a lot of this stuff is gems. I mean, this is just for the audience. A lot of things that you are dropping, is gems because I always think knowledge is always important. But for people who really just want to get into investments, and I'm glad Tim asking these great questions. I would have never known, you know what I mean, that you have to be 100 miles apart. You know what I mean, I would have got one in Wilmington, and I would have grabbed the house in Middletown, and I would have been in violation.
Right.
I mean, of the loans. So I appreciate all the knowledge that you're dropping.
No problem, man.
Trying to get down there to Atlanta.
Now,
Come on down, man. Come on down.
now one of the things, one of the guys that I look up to is Don Peoples as far as real estate. Because if you don't know me, I'm into real estate. And one of the things that he said is that as far as minorities is concerned, there's a lack of a, a lack of funding as far as being able to invest, not even necessarily in real estate, but there's just a lack of capital in a sense as far as minorities is concerned. And looking at different articles, I've seen one that was saying that there has been discrimination in the housing market as far as mortgage lending is concerned. With your experience, have you noticed that at all? If so, what are your opinions on it?
Um, I haven't seen in terms of, so when a person fill out an application, they put all the information on. In terms of that type of discrimination, I haven't seen it. I will say that in certain markets where it's predominantly minorities, African American, Latinos, the housing values aren't there, and they could be. You look at the right now is probably the best time ever in real estate, and I bet you if you go to some of those areas, you will find that the values of the houses have not increased. I read a statistic, man. I think African homes for African Americans, man, have $156 million less equity than our counterparts. Um, we own less land now than we did 100 years ago, which is right after slavery. Um, you know, the lack of home ownership um, is just, something that we have to push, man. And it's not get rich quick. And the statistics show that if you're a homeowner and you have kids, your kids typically do better. You do better because you're stable. You don't have to move every 12 months because Mr. Bookman needs to sell his house or, doesn't want you in as a tenant. So, we definitely need to continue to fight for home ownership. But I will say, man, just being a professional in this industry for 17 years, whether it's up north or down south, we're missing a lot of components, man. We're missing. I've never met, out there, I never met an African American appraiser. There are a few here, so we need African American appraisers because we're going to look at locations differently as opposed to our counterparts. Tamon, if we go home and we, go to certain parts of town, it's just in town. We're not looking down on it. It's just in town because that's where we grew up at. Dom, when you go to, North Philly, it's North Philly. You know what I mean? I think it's changed a lot since the last time I've been there, but we look at it differently than other people. We don't look down. It's home to us. You see what I'm saying? So we need more appraisers. We need more people in real estate because our neighborhoods are just as valuable as any other neighborhood. But we just have to have that pride of ownership.
Definitely, definitely. I didn't want to put you on the spot on that, you know what I mean? But I mean, this is a show that we speak on it, and you know what I mean. If one of the things that I'm big on as far as pushing knowledge is Black home ownership and how we can use that as far as a wealth vehicle, whether it be using our credit to obtain different assets in real estate to close the gap. Because one article that I seen was that by 2056 that the median Black wealth is supposed to be at zero, and I seen that in 2000 I think 17, and that bugged me out. Like, and just looking at the statistics now, and like you're saying, we need more people in these areas because, for instance, me living in northern Delaware, looking in Wilmington, right, and seeing how there's different gentrification going on, and then certain parts it's not. And then when you look at the value of what they say this place is, it's like, wow, like this is still the city of Wilmington. You know what I mean? Like there's not too far away that you have the Chase centers and all these big skyscrapers or whatnot, and these new apartment buildings. Why is it that this area is the mean to this value in a sense to where you got to figure out people, one of the notions is like you don't want to invest in there in a sense. Like you just want to buy something and buy and hold. And that to me is like you shouldn't have that type of mentality. Like if you had, like you said, for instance, even going back to my hometown, um, if we had the ownership of, and pride of like how it looked in a sense, it would raise the value. You know what I mean? And these areas are now deemed as opportunity zones to where now there's an incentive to build these areas up. And if we can have more people in real estate, like Kevin in lending, to educate us on different areas that we need to improve on to close that gap, or not even just to close that gap, but just to better us as a whole, I think is beneficial.
Yeah, you're right, man. It's that's part of the reason why I do what I do is just to educate, people in general, especially our people, and close that gap. Um, bring up the value of the homes in our area, and pride of ownership. And we got to stop selling grandma's house. You know what I mean? We got to stop selling it. We got to stop losing. We need to make sure that we can keep it and stop trying to get that quick buck in a lump sum. And because God didn't make it any more land. Just not. So you just hold on to it for as long as you can and do something with it. Build a house on it, build a rental on it, do something, hold on to it. If you don't want to do nothing with it, hold on to it so it stays in the family. Just, take pride in ownership, and, just, it is the wealth. It helps build the wealth gap. Like my mother passed, I've got her house. She passed it down to me. Even though my kids would probably never go back home, I'm not selling it. If they sell it, then that's a different story. But I don't plan on selling it. Even though I'm way down here, 12 hours away. So just holding on to it for as long as possible, man, and just building wealth and, constantly educating. We can have the flash and dash later, but let's build some wealth right now. The problem is we wear our wealth. Example, look at, $1 million Jay-Z versus $1 billion Jay-Z, and look at the difference in how he dresses. Doesn't have to change. Yes, he's got expensive stuff, but it's basic. You know what I mean? You look at two of the wealthiest men in the world, Bill Gates and Warren Buffett. Both of them look like they shop at Walmart. You know what I mean? Like they don't wear their wealth. But then let's look at our rappers who, don't make as much money as they used to make because of the type of deals they have, and you think they were richer than Bill Gates because they got the flash and dash. So, that's the biggest thing, man. It's just, if people don't know who Don R. Peoples is, they need to know who he is. They need to know who he is, man. I got turned on to him through an investor probably about a year ago, and we were 2 hours from DC, and I had never heard of him. So now, he's one of very few Black developers in the nation, and I think his son's starting to take over what he was
doing. I like what both of y'all are talking about. It's one of the things I was just talking to my wife about.
Both of y'all, you talking too?
Well, when we're talking about, we're talking about keeping property in the family. I was just talking to my wife about this. Is saying like, just buying like having the family. A lot of people in your family just own a house on a block. You know what I mean? And that way, if you keep it, now that is a family block, right? That's a family house, and that's another way for just me. From the outside looking in, that's another way to close that gap as to own home ownership. You know what I mean? Just own the land. Like if my whole family owns a block, like me and my siblings all have a house on that block, and then if we do leave, that's something that we pass down to our kids, and that way we don't have to um sell a house, or somebody else coming in and they don't like how we do things, or they don't like how me and my wife do something in the neighborhood, and now, like Tamon said, they coming in and they want to re-gentrify the whole place. But it's just holding on to those properties and holding on to those land, and trying to do it as a family as opposed to doing it as me being the one that's just trying to do it. I think that's important as well.
Yeah,
Right, you're right, man.
I'm,
That's a good point.
I'm definitely not against gentrification. You know what I mean? It's just a matter of who's doing the
Who's
gentrifying.
doing it? Yeah.
Um, but even when we're talking about gentrification, that will be pretty much changing the landscape. One of the things that you had touched on in the past in the conversation was about Cash App um, as a means of payment and whatnot. How has technology affected mortgage lending?
How has technology
Hmm.
affected real estate?
Well, yeah, I mean, we that's broad, but I wanted to be specific to mortgage lending.
Um, so in mortgage lending, man, everything is documentation. Um, so if you use Cash App to pay your rent, Cash App has to come from your checking or savings account. So not only do you need your checking and savings account information showing that it came out, you also need that documentation showing the Cash App of where it went to. So as you use those things, um, you're adding layers of documentation that's required. At some point, they're going to most likely adapt, but right now, mortgage lending is taking incremental steps in learning, moving towards it. Because the biggest thing is, and I get fussed at all the time, is I'm asking for so much paperwork. Would you lend me $200,000 without knowing where it's going to come back to? Would either one of you give me 200 grand and
No,
I just give you a pay stub? You not
Nope.
verify with my employer. You not see if I got any money in the bank to even start paying back. And that's what
Yep.
people have to understand. If I go to somebody asking for $20, they want everything. They want some blood samples and everything to make sure when I'm gonna get my $20 back.
Yeah.
You got to look at it on a larger scale. It's the same thing. We're lending you hundreds of thousands of dollars in hopes that you pay it back to us on time.
now have you seen as far as this time COVID, where there's not too much as versus person to person contact? Um, have you seen there be a difference as far as the technology involved in the mortgage lending process, as far as obtaining homes, whether it be a rental or buying a home? How has this technology, as far as whether it be Zoom or DocuSign or anything, how has that helped or, in your opinion, hurt the mortgage lending as far as this time in COVID?
Man, I actually think it's helped us progress to a level that we probably should have been at this point in time. Um, right now, attorneys' offices are having digital where the person doesn't even have to attend the closing. I have real estate partners who just do virtual showings. In some cases, where they just either view it and or do a FaceTime or Duo or something just to show their client the house. So it's helped us progress. For me as a lender, everything's done virtually. So the person can go online, they can fill out the application, upload their documents. I can pre-approve them or give them a game plan and just reach out to them with a phone call or go over it with them through Zoom and show them a screen. Share my screen with what we see, so they can verify it. So it's helped progress us, and kind of showing us that we probably should have been here, a couple years ago with all the technology. because Zoom just didn't happen, but we weren't utilizing it for as many things as we do now.
Yeah, that's one of the takeaways that, I mean, hopefully we'll get to a normal, but I mean, in the landscape, it just learning that the technology that can be used just in real estate as a whole, whether it be the virtual showings, or using like 3D cameras, not 3D, 360 cameras, just using the technology to your benefit to where you can actually stretch out a lot further. And I mean, just seeing how just the real estate process is going, and to me, I can see how it can be a benefit if used correctly, and hopefully not monopolized on in a sense. But I think that if we do get back to a normal, like you said, it seems like it's been innovative, and it seems like it's been a seamless process as well. So, I mean, I think that it might be a benefit for um, real estate as a whole, as far as this technology, how it can be used outside of this pandemic going forward. What are your thoughts,
Yeah, I
Kevin?
think so,
Go
man.
ahead.
So let's kind of take it. All right, let's say it's a property in Wilmington that I'm interested in that you have. Um, Instead of me having to take a flight to Delaware, and then, I mean, Tim, I know you since you were a kid, so I mean, I trust you. But now you can say, hey, Kev, let's do a Zoom call, and I can show you all the aspects of the house.
Yep.
Saves me a flight, and I can see everything. Even though we had that same technology, we might have did it. I probably would have flew to Delaware just to take a look.
Right. Definitely. Definitely. And same thing for Georgia too. Listen.
Same thing, man. Let me know.
I got family in Georgia as well. Cause listen, you know what? I'm gonna shut up. Go ahead, Don.
I ain't got nothing on that. But to piggyback on what you were saying as far as the technology, I do agree that it is enhancing, or just enhancing the way that people do business. Like you said, I no longer have to be in a specific place to do business, you know what I mean, or to close on something, or just to actually see a property. And like Tamar was saying, I seen something the other day where they did the virtual showing, you know what I mean, where they had everything staged virtually. The house was empty, but they had it staged, you know what I mean, the virtual couch, the virtual settings and everything like that. So I do believe, and I do think that this is the way that we should have been doing it, and I think this is the way that it's probably going to be moving in the future. So I definitely agree that it is actually enhancing the business.
One more lending question. I didn't highlight it. Getting approved for housewives / house husbands or self-employed. How can you get
um,
how can that happen? Or can it happen?
so you're saying if a person is self-employed, um, if they can get qualified to purchase a home,
Yeah.
so you have to document your income. Like I said, it goes back to documentation. So if you're a barber or a cosmetologist and you want to purchase a home, you need to make sure that A, you're doing your taxes, and B, you're reporting enough income to sustain and show that you can purchase a home. So for maybe 2 years, if you're in the process, you may need to um, not write off as many things so you can show more income. Because at the end of the day, even though you may make $100,000, the government is not going to give you credit for money you said you didn't make on your taxes. So you need to show as much income as possible on your taxes in order to qualify. So it goes back to documentation, and you would need your last 2 years of tax returns. So that would be at this point, it'd be 2018, 2019, in a year-to-date profit and loss statement, and that profit and loss statement would be from January 1st to right now August the 10th.
So like we said earlier, there's no obstacle stopping you. There's nothing
No
stopping you
obstacles at
guys.
all, man. You just
Um,
got to document everything.
Documentation. Dom, do you have anything?
Nah, just taking it all in, man. I think y'all gave me a lot of stuff for my final thought, um, which is super important. But I touch on that with my final thought. But I got no other questions. This is it's 8:23 anyway. Just wrapping it up anyway. Um, but yeah, I got no questions. I think that y'all touched on a lot of the.
You keep saying y'all, brother. You was
Yo,
in this.
you and
I
Kev,
did
man.
nothing. I asked
I was a
questions.
participant in here. I was a
You was not a
participant. You
participant.
know what I
I
mean?
asked
I took my
questions.
notes.
Listen, I'm gonna run this back tonight.
Listen, it was a good show. I think Tamon, again, you did a good job with mixing in the questions as far as personal and business side of it. And there was a lot of good gems that was um thrown out there, especially from the investor side of it as well. So I think this was a great show. But I have no more questions as far as the credit side is
Well,
concerned.
um, so from what I got from this, there's no obstacle as far as purchasing a home. You got to put the work in when you're talking about your credit, knowing your debt to income ratio. Utilization is one of the things they said, keep it under 30%. Um, they have a new FICO, don't they? A new FICO, like it's a FICO 10. I know Shannon was saying something about that. To where some of the things are different. And let me know if I'm wrong or not, please. I heard to where if you keep your balance, like you can not 30%, but like keep your if you don't pay your balance off, like keep like a $3 to $5 balance on your card, that may help you. That a
Like 5%.
is that the credit realtor question or
Yeah, it's kind of credit realtor question, but it could be my question as well. Um, Sometimes, so just easy to sum it up. Sometimes, depending on the person, paying it down to zero doesn't always benefit you. Just kind of depends on what you already have reporting on your credit. So like I always tell people, try to keep your credit card utilization between 30 and 10%. And, sometimes just keep them $10 on there just so something's reporting. So, but it all just depends on your scoring algorithm. Each one of us has a different credit profile, and mine may be to go ahead and pay it down to zero. Tim's may be to pay it to 20, and Dom may be just to keep it where it's at, to keep the score where it
I did lie. I do got a question.
he said I lied.
It's more so of like how we can, as minorities, how we can get better. Yeah, I mean, as far as bridging that gap with credit. So, what are some of the challenges you see coming in where people, minorities, um, some of the obstacles that I know we touched on them a little bit as far as you said um, low car loans, you talked about student loans, stuff like that. But even outside of that, those things, what are some of the mental blocks that you see us as minorities trying to purchase a home? Some of the things that we can do better with purchasing a home mentally or getting over that mental block.
I mean, seek professional opinion. A lot of times people get information from family members or friends who don't own a home. So if they haven't been through the process, then sometimes it's a deterrent. If you have an issue with your credit, first check your credit. That's the biggest thing, because if you don't check your credit, you don't even know if you have an issue or not. So check your credit. If you have an issue with credit, reach out to a lender like myself and see about getting pre-approved, and we can run your credit and give you some game plans. Or reach out to a credit repair company, preferably Shannon Payton Credit Consultants, to help get credit. One thing I see a lot of is over small things. We will spend the money for bankruptcy when I think it's probably better used to go to credit repair. It may take longer, but depending on your circumstances, that it could, help you, because everything on your credit report isn't right. And it's just mindset, man. We didn't get in the whole get bad credit overnight, and it's not going to be overnight before it's taken care of. So it's mental. It's mental. It's challenging. It's not easy. You have to stay on it, and it's work. It's work. Constantly keeping your credit up. A lot of people have co-pays, and you don't pay the copay at the doctor's office, and then you forget that $25, $30, and they keep sending you notices, and you don't open it. And next thing you know, it's on your credit, and it's not affected your credit. Buy here, pay here's, Comcast bill, turn that equipment back in, your cell phones, stop running up the bill. It's just a lot of small things that affect our credit, and it's constantly that I see with our people. It's just staying, working on your credit is tough. That's why Shannon gets paid to do what she does, because it's not an easy feat. It's better to try to maintain it while it's in good standings. And we know life happens. Life's happened to me as well. So I'm not going to say, but at least you just gotta, when it's messed up, don't avoid it. Because sitting there, a lot of people think that after 7 to 10 years it falls off. Some, depending on where you're at, the statute of limitations, on the 6-year, 364th day, they could sell that debt, and here you are waiting another 7 years. So you need to attack the problem, get it removed from your credit, or pay the bill, so it can fall off in its designated time.
I think that was awesome. Yeah, man. But just like I said, just the whole mental aspect. Because we talk a lot about the what you should do, right? Pay this off, do this, do that, right? But like Kev said, just the little things, like skipping on the co-payment at the hospital. You know what I mean? Or not turning back in that Comcast equipment. I know I've done both. And then you look up, you like, man, I got this $500 Comcast bill on my credit. And then they've been calling you saying, listen, we've been trying to reach out to you and say turn back in that equipment. You know what I mean? Or you the doctor's office calling you saying, listen, we want this $25 copay, and then now it's $300 off of a $25 copay. You know what I mean? So a lot of those things is mental things, that mental blocks that we can get over. So this is a part of the show where it's a final thought. I want to thank Kev for actually coming on and doing the show and dropping these gems and knowledge. Just want to say we appreciate you, and tell the people where they can reach you at, Kev.
You can reach me on Instagram at The People's Lender. You can reach me on Facebook as Kevin Jefferson or Kevin Jefferson Mortgage. If you have a mortgage question or want to know how to get started, we can set up a consultation. I can be reached at 470-485-6267.
All right, so I guess I go my final thought first, because I know Dom got some Dami Lama treatment for us, as we call it. But like Dom said, I definitely appreciate you coming on, extending your knowledge and your wisdom, and definitely appreciate it. Definitely gonna run this back so I could write down the gems that need to be written down. But what I got from this was, for one, you can refinance your car to help that out. That was a gem. But just summing everything up is that we have to get more people involved that look like us in areas that we aren't involved in. And I say that because we look at us, and one of the things, it was who just built the school? Somebody just built the school. Was it Jay? Jay just built a school, or is partnered up with a school with Long Island University, and it's about entertainment and sports. And that has been the driving force for our wealth vehicle in America, has been entertainment and sport. But we need to venture out in different avenues and different areas, so that way we aren't just looked at as basketball players and athletes and rappers, and those aren't the ones that we're looking up to. That we have more people that are looking up to and know about a Mr. Donahue or any of the. We had an episode about black men that you need to know, and that was very educational. But some of the things, even Bass Reeves, we don't have enough of African Americans in law enforcement, and that may be one of the reasons why we're here today. So that just my final thought is that we need to be more involved in avenues that seem like it's a foreign territory for us. So that way we can understand the landscape of America. Sum it up.
That was great. Kev, you had a final thought?
Yeah. Let's take action. Let's take action and, look at our credit. Let's take action with building wealth and a legacy for our family. If you got some hiccups, that doesn't stop you from being able to progress. You just have to work on those issues. And avoiding them doesn't help. Take action, man. Issue with credit, you guys can reach out to Tim and Dom and have them get Shannon Payton's information on your credit. You want to know about a mortgage, you can reach out to me. I'm sure there's other topics that you guys have, life insurance, whatever. As soon as your baby's born, get $1 million policy. You know what happens? Your grandkids become millionaires right off the bat. So, let's just, bridge this wealth gap and, just work on buying the block, improving our communities and giving back, and let's not, be selfish. I knew so many guys, man, when I got older and into real estate, I found out so many older guys had owned so much real estate, but they never taught us. You would have conversations with them. They never passed that information down to us to, to help us, progress. So, what you guys doing is an amazing platform. I hope it's as big as you want it to be, if not bigger, and just keep going, man. Like I said before we got started, if there's anything I can do to help or anybody I can send your way to help your podcast and get you more exposure, I'm here to help.
Appreciate it. I think both of y'all, man, combined touched on my final thought. But it's be the change that you want to be. So Tim talked about getting into the avenues that we struggle with, right? Like becoming more conscious about what you're doing with your real estate, becoming more conscious of what we're doing with our credit. So that way you don't see yourself in these areas. You don't see yourself struggling in these areas. We talk about needing more Black investors or needing more Black appraisers and stuff like that. But even taking this step further, becoming involved in law enforcement, being more Black officers in your city or in your state or wherever it is that you are, wherever you can affect change, do that, be that. Don't just talk about it. Like Tim said, don't just talk about it, but take action. Take action in the change that you want to see. You're tired of and I know I'm tired of it as well, but we're tired of seeing Black men gunned down. We're tired of seeing Black men or Black people not get the same passes that our other contemporaries are getting. But be that a change. Take action. Learn more about the real estate game. Learn more about law enforcement. Learn more about the things that you that you don't like. I heard something today. They said where there's a problem, there's opportunity. So where you see there's a problem in your city, or there's a problem in wherever it is that your sphere of influence, there's an opportunity for you to step up. There's an opportunity for you to take action. There's an opportunity for you to insert yourself. So not just about the real estate game or the mortgage lending game where there's multiple opportunities, but just in life where there's an opportunity, where there's a problem, then there's the opportunity for us to take action. And that's my final thought. Take action, be the change you want to see, and take advantage of the opportunities that are afforded to you. That's my final thought for the day. And housekeeping, we are on Spotify. We are on YouTube, so follow us there. We are on Instagram, Twitter, as well as Facebook every Monday, Wednesday, and Friday. And I think we'll get something. I'll talk to Taman and Biv about posting our link tree up on our chat, so that way you can easily get to any one of those platforms for us. But that's our show for the day. If you have any questions, if y'all have any questions about further shows, shows that y'all want us to talk about, let us know. Speak on it, and we'll try to get those shows to you. But until then, y'all, speak on it, y'all. I'll let you.